Good morning. I want to welcome everyone participating in today's webinar, Developing a Bulletproof Plan for Implementation of FASB's new lease standard. My name is Zena Metzger, and I'm an audit senior here at GRF CPAs Advisors, and I'll be today's session moderator. I'd like to start off today with some quick housekeeping items and explain what you will need to do to earn CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically following the webinar. You'll be asked to recall 3 words in order to receive credit. Please write down the CPE words when they are given and hold on to them until you receive your certificate, as they will not be provided again. If you have any technical questions or issues during the discussion, please use the chat function to speak with our administrator for assistance. The slide deck and recording from today's discussion will be available on the event page on our website. Technical support and CPE questions may be addressed to Nathan McElveen at nmckelveen@grfcpa.com. Today's learning objective is to provide attendees with a better understanding of the new lease standard and practical solutions for implementation. I will now introduce our speakers for today's webinar. Amy Boland has been working in auditing and public accounting for over 25 years. She specializes in audits of nonprofit organizations, including associations, private voluntary organizations, and other charitable institutions. Ms. Boland is also a founding member of Women on the Move, GRF's leadership initiative, formalized in 2019. She's also a member of GRF's executive committee. Susanna Chan is a senior manager in the audit department at GRF CPAs Advisors, specializing in government contractor clients. With 12 years of professional experience, Ms. Chan specializes in providing compilation, review, and audit services for government contractors. I'll now turn the presentation over to our speakers.
Thank you, Zena. Good morning, everyone. It is a pleasure to be here today to present with Sue on the new lease standard. Since this is a topic that affects both for-profits and nonprofits, I'm excited to be able to work with Sue on this webinar. The terminology will be based on the standard itself and not specific to nonprofits, as many of you may be, but we will try to incorporate both when necessary. Here is what we will cover today. The changes in the lease accounting as a result of ASU 2016-02, which is topic 842, for both lessors and lessees, the implementation of the new standard and common issues faced, changes in the disclosures, and then considerations and tips for implementing the new lease standard. Who does this apply to? No, why, sorry. Why is the standard issued? Basically, leasing is used by many entities. The prevalence of leasing means that it is important that users of the financial statements have a complete and understandable picture of an entity's leasing activities. FASB wanted to increase the transparency and comparability among organizations. Previous lease accounting was criticized for failing to meet the needs of the financial statement users because it didn't require the lessees to recognize assets or liabilities that arose from those operating leases on the balance sheet or the statement of financial position. Many of the criticisms associated with the previous lease guidance related to the accounting for operating leases in the financial statements of lessees, and addressing those concerns with lessee accounting was the main focus of the board. As such, the board decided not to fundamentally change lessor accounting with this update. Under the prior leasing standard, which was ASC 840, many companies disclosed their leases in the financial statement footnotes, and they were not recorded on the face of the financial statements themselves. The main difference between previous GAAP and 842 is the recognition of the lease assets and liabilities on the balance sheet by the lessees for those leases classified as operating leases under previous GAAP. The board determined that the economics of leases can vary for a lessee and that those economics should be reflected in the financial statements. Thus, topic 842 does retain a distinction between finance leases and operating leases. The most significant change in the accounting standard codification involves the lessee model, which requires the leases to record that right of use asset and the lease liability on the balance sheet for almost every lease. This, as I mentioned, significantly differs from the legacy accounting for operating leases, and under which leases were before viewed as executory contracts and not recognized for accounting purposes. So accordingly, they were solely disclosed in the notes to the financial statements instead of on the face of those financial statements. And now, who does this apply to? As I mentioned, this really applies to all entities, both nonprofits and for-profits that enter into a lease, and it applies to all leases and subleases of property, plant, and equipment. It does not apply to those non-depreciable assets that are accounted for in other FASB ASC topics, like the leases of intangible assets or leases for the exploration of minerals, oils, and natural gases, those biological assets such as timber, leases of inventory, and then leases of assets under construction. It is not applicable for. So when is the effective date of implementation? It seems like we've been talking about this standard for years, and in fact, I really think we have been. However, the time is finally here for everyone. The adoption of ASC 842 is mandatory and is effective for all companies for fiscal years beginning after December 15th, 2021. It had been delayed for several years for various reasons, and most recently delayed due to COVID, but it is now effective for fiscal years beginning January 1st, 2022. So that means if you're for your calendar year ends, the first reporting date under the new standard will be effective as of December 31st, 2022 in those financial statements. Early implementation was permitted, and some organizations did elect to early implement, and we had a lot of those, but now we are here, so the time is now to go ahead and implement. And now we can talk about the implementation methods. Under ASC topic 842, it does require a modified retrospective transition with the cumulative effect of transition, including the initial recognition by the lessee of right of use assets and lease liabilities for existing leases as of either the effective date or the beginning of the earliest comparative period presented. Now, under the effective date method, the entity's comparative reporting period is unchanged. The reporting periods are presented in accordance basically with US legacy GAAP and under topic 840, while the periods subsequent to the effective date are presented in accordance with 842. A lessee may elect not to apply the recognition requirements to short-term leases. Those are those leases that are 12 months or less. But they may recognize the lease payments in the profit and loss or the statement of activities on a straight line basis over the lease term, which is the same as an operating lease under topic 840. This saves the time and effort of maintaining lease schedules for those leases of short duration. And the same applies for the variable lease payments in this case. They can be recognized in the period for which the obligation for those payments is incurred. And these are really payments that are made directly by the lessee for taxes or insurances, which are considered these variable lease payments. So I think basically looking at this, electing to use that effective date and not including those short-term leases, they're really supposed to ease the burden of the implementation of the standard. FASB did provide some practical expedients. And these were really to reduce the cost and the complexity of the implementing the standard. And the first three are a package and they must be elected together. And they start off with the identification and classification of the leases that commence before the effective date. So this provides the entity relief from the burden of having to determine whether leases are including in existing or expired contracts at the transition date. Many entities like trucking companies or airline industries have many leases, at that implementation date. And they would elect this expedient given the significant cost to have to go review all the contracts and determine whether they do or do not contain a lease component. Entities also provide relief. Entities are provided relief from having to reevaluate existing lease classifications. A capital lease under topic 840 would not be significantly affected if it meets the criteria of a finance lease under the new standard, because basically it would just be a name change for those asset and liability accounts. But a reclassification from an operating lease under the old standard to a finance lease under the new standard would require changes to a whole class of similar leases on the income statement. It would be well advised not to elect to reclass and reassess. It will just cause a lot more work for everyone. And then finally, the third item in the package allows the entity relief from having to identify those initial direct costs that commence before the effective date. And those are those costs that would have been avoided if the entity had not entered into the lease agreement, like the legal fees that may be incurred around lease execution. And then outside the package is the practical expedient to use hindsight in determining the lease term and assessing impairment. So for example, if you have a 10-year lease for office space and you have an option at the end of that to extend it for 3 years, let's say in the year of implementation, you are in year 9, and you now know whether or not you want to extend if you still need that space, or if you are going to extend and use that space. And I think this is actually very helpful right now because of all the organizations that are actually looking at their space, their office space right now. And maybe because of COVID, they want to downsize, or they're getting rid of their offices entirely. But you can now use this information to move forward to know how to properly calculate your lease calculation. And this is the same in the option to purchase at the end of the lease. At the time of implementation, you may not have known if you were going to purchase the equipment or not, but now using hindsight, you may know. And when there is a purchase option in a finance lease and the lessee is reasonably certain to exercise, the lessee has an additional payment to make that should be included in the lease liability and then amortized over the life rather than the lease term. So this basically allows you to save time and then instead of remeasuring at a later date. And I'm actually going to turn it over to Zena to do the first polling question.
All right, we've come to our first polling question. Have you identified the leases that are impacted by the new lease standard? A, yes, B, no, or C, unsure. Please take a moment now to answer. While participants are submitting their answers, I will provide the first CPE word. The first CPE word is asset. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the first CPE word is asset. A-S-S-E-T. All right, so it looks like over half of you all do, which is good. And I will turn it back over to our next speaker.
Thanks, Zena. Actually, what we're going to start here is what exactly is a lease. So topic 842 defines a lease as a contract or part of a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. And in that definition, control means that the customer has the right to obtain substantially all of the economic benefit from the use of the asset and the right to direct the use of that asset. So once you've determined if you have a lease and it exists, you have to figure out what type of lease you have. So there are two types. There's the finance lease and the operating lease. And the finance lease is basically similar to what was the capital lease under the old standard. And you have criteria to look at to basically identify if you have one of those, then the finance lease would be applicable. We'll look at some of those criteria here, and that is that the lease transfers ownership by the end of the lease term, that there's a purchase option that is reasonably certain to be exercised, that the lease term is for a major part of the economic life of that asset, and then the present value of the sum of lease payments and any guaranteed residual value equals or exceeds substantially all of the fair value of the underlying asset. And then the fifth one, which was not in the old standard, but it is a specialized asset that has no alternative use to the lessor at the end of the lease term. And ultimately, really, if that fifth one applies, there's probably one or two more that already have applied anyway, just to note. And then one other thing to note too is, if you'll notice, under the old lease standard, there were percentages. So it was 75% of the lease term of the remaining economic life, and it was 90% of the lease payments. And now they're really just saying that it is a major part, and that it exceeds or substantially all of the fair value. One thing to note is that most companies still have been using to stick with the 75% on the lease term and the 90% on the present value for continuity purposes, as deviating from that will likely cause additional work and documenting why you came to your conclusion and what percentages you were using. And then just to note, as I said, this is a finance lease, but that's what is called for a lessee. It's called a sales type lease for a lessor. And in a sales type lease, the lessor is assumed to actually be selling a product to the lessee, which calls for the recognition of a profit or loss on the sale. And then basically, if none of these criteria apply, then you have an operating lease. And again, that's what it's called for a lessee. It is called a direct financing lease for the lessor. And a direct financing lease is a financing arrangement which the lessor acquires assets and then leases them to customers with the intent of generating revenue resulting from those interest payments. Once you've determined that you have a lease, then you have to determine if there are any separate components in your lease. Because if there are, those have to be accounted for separately. And you have distinct lease components if the lessee can benefit from the right of use either on its own or together with other resources, and the right of use is neither highly dependent on nor highly related with other rights to use the assets. So you have to determine, is this component a lease component then, or is it a non-lease component? And we'll talk about those here as well. So components only include those that transfer a good or service to the lessee. And Nathan, can you advance the slide? Thanks. But those extraterritorial costs that are considered part of the lease, such as real estate taxes, insurances, if included in the fixed payments to the lessor, they are considered part of the lease. But a right to use land is considered to be a separate lease component unless it's basically immaterial, has an immaterial effect on the accounting. And just to discuss the non-lease components, some examples of those are basically when you have common area maintenance of your leased office space, or if you've maybe provided receptionist services for a sublease tenant. And then again, just making sure we understand that payments directly to taxing authorities or other insurance providers are generally considered variable lease payments. Now, there is a practical expedient here. A lessee may elect an accounting policy by asset class to include both the lease and the non-lease components as a single component and account for it as a lease. This expedient is not available for lessors. Making this election will relieve the lessee of the obligation to perform a pricing allocation to each component, although it will increase the total lease liability recorded on the balance sheet or the statement of financial position. So if you do have separate components, you have to determine how that contract consideration is allocated. And you'll need to determine the standalone price of each component as defined by the agreement. But if it's not defined in the agreement, you still have to define it, and you're going to have to use some of the other information, whether in the agreement, and try to figure out what that standalone price is and estimate that. You may also need to use the residual estimation approach if that standalone price for the component is highly variable or uncertain. Once you have that, then you have to allocate the consideration in the contract on a relative standalone price basis to each of those separate components. And then if you have any initial direct costs, you allocate those separate lease components on the same basis as the lease payments themselves. Then I just want to look into lease classification and how this is affected on the financial statement presentation. So as we said, we have the two types, the finance and the operating. The finance lease is really, again, like the capital lease. So it doesn't have a whole lot of effect on your financial statement presentation or a whole lot of change. But it will change on the balance sheet and the statement of financial position. You will have a name change that'll be called a right of use asset. And then you'll have a financing lease liability as well. On the income statement or the statement of activities, it's really just the same. It's that interest expense and amortization of the expense of the right of use asset. And then the cash flow will be similar as well. You'll have those repayments of principal payments in the finance section, and then just the payments of interest on the lease liability and the operating activities. But it will be different for the operating lease. As I mentioned earlier, this normally would have been a footnote disclosure. But now on your balance sheet and your statement of financial position, you're going to add that right of use asset and that operating lease liability. On the income statement or the statement of activities, you'll have a single lease cost, which is really calculated so the lease is allocated on a straight line basis over the term of the lease. And then the cash flow will be similar as in the operating section, like the finance lease for that. And once you've identified your lease and your components, you now have to figure out how to record it. And this was obviously something new that will be for the operating leases. And you start basically with the lease liability. This is calculated as the present value of the remaining minimum rental payments and any amounts probable of being owed by the lessee under the residual value guarantee. And this discount rate used to calculate the present value will be determined at either the earliest period presented or the commencement date. I'll talk a little bit more about discount rates in a minute, but I want to keep moving on with what happens after you have your lease liability, because then you basically go to your ROU. The right of use asset is actually equal to that lease liability, and then it has certain adjustments that is included. Those would include the prepaid or accrued rent, remaining balance of any lease incentives, any unamortized initial direct costs that would have been capitalized, any impairment, and then the carrying amount of any liability related to the lease you recognized in accordance with the old standard, the exit or disposal cost obligations. And I think the thing here to point out is what we see a lot of is those lease incentives on the office space, like the moving expenses or rent abatement. And ultimately, the ROU asset does get adjusted for those. And in effect, that reduces the lease expense if it is an operating lease, and it reduces the amortization expense if it is a finance lease. And then I did want to just touch base on the discount rates that you apply. Ultimately, the lessor should apply the rate implicit in the lease. The lessee should apply the implicit rate or the lessee's incremental borrowing rate if the implicit rate cannot be readily determinable. It is important to first note that the implicit rate should be used before any other rate if it is readily available or can be accurately calculated. This is explicitly stated in ASC 842. Specifically, it's 842-20-30-3. It specifically says a lessee should use the rate implicit in the lease whenever the rate is readily determinable. This will obviously be known to the lessor since they drafted the agreement. However, the lessee is rarely privy to this information. So therefore, readily determinable by the lessee may not be. Although it can rarely be calculated, it is beneficial because it will generally be higher than the incremental borrowing rate, which will result in a lower lease liability. So let's talk about the incremental borrowing rate as well. The rate which is the rate of a lessee that the lessee would have to pay to borrow an amount equal to the total lease payments on a collateralized basis over a similar term in a similar economic environment. The IBR is more commonly used by the lessee to calculate the lease liability than the implicit rate. However, it too can be difficult and expensive to obtain. The IBR is, especially by companies who have large portfolios, and they may not have the information like comparable credit spreads readily available. So companies may choose to engage external firms that specialize in valuations or third-party lenders or other parties to basically get an accurate estimate of what their IBR is. So this can significantly increase the costs associated with compliance with ASC 842. Now, there is an expedient option, the non-public public entity exception. This permits the use of a risk-free discount rate determined using a period comparable to that lease term as an accounting policy election for all leases. The risk-free rate is by far the easiest rate to determine under ASC 842. Rather than requiring a complex calculation or research, the risk-free rate can simply be found online at the Treasury website. While this alternative minimizes the work and the potential costs with evaluating the discount rates, with a private company with a large lease portfolio, the risk-free rate is often the lowest of the 3 discount rate options. So when calculating the lease liability, the lower the risk-free rate can cause a materially higher lease liability, especially since it has to be applied to the entire lease portfolio. So I just want to sort of go back over that the practical expedient says the non-public entity can make a policy election to use the risk-free rate for all leases. So however, last fall, this was updated. The amendments in Accounting Standard Update 2021-09, which is the discount rate for lessees that are not public business entities, did permit a risk-free rate election by class of underlying asset rather than at the entity-wide level. So FASB was receiving feedback that some of the companies were reluctant to use the risk-free rate election for all leases because the rate were so low, such as the US Treasury rate. And it's basically ended up being lower than their expected average incremental borrowing rate. Therefore, the use of that rate election could increase the entity's liabilities and right of use assets. So 2021-09 did permit the entity to elect the risk-free discount rate now under the practical expedient, but by underlying asset instead of it being required for all leases. However, it does clarify that the lessee must still use the rate implicit in the lease when it is readily determinable, even if they have elected the risk-free discount rate as an expedient. So entities that have not yet adopted Topic 842 as of November 11th, 2021, are required to adopt ASU 2021-09 at the same time that they adopt Topic 842. For entities that have adopted 842 as of November 11th, 2021, the amendments in ASU 2021-09 are effective for fiscal years beginning after December 15th, 2021. So basically in effect the same time as the standard is now. And now I'm going to turn it back over to Zena for the second polling question.
Thanks, Amy. All right, we've now reached our second polling question. If you have prepared a lease calculation, what discount rate did you determine was appropriate? A, rate implicit in the lease. B, incremental borrowing rate. C, the risk-free rate. Or D, do not know yet. Please take a moment now to answer. While participants are submitting their answers, I'll provide the second CPE word. The second CPE word is lease. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the second CPE word is lease, L-E-A-S-E. All right. From the results, it looks like many of you are unsure. I will now pass it on to Sue.
Hi, everyone. So before we jump into some basic examples, I wanted to point out that there are some other considerations that we'll briefly go over that will impact how you account for leases. We won't be taking a deep dive into these other factors for the sake of time. There's just so much in this lease standard, but I thought that these were the most mentionable considerations that you have to be aware of as you implement Topic 842. One of these considerations are modifications to leases, which is obviously very common in a lot of the lease agreements that we have. If your lease has a modification, then you must assess the nature of these modifications to see if you need to account for the mod as a completely separate contract. Two factors that you need to assess when you have a modification is considering if the mod includes an additional right of use asset that was not included in the original lease, and if the lease payments increase are commensurate with the standalone price for the additional right of use. So for example, if you have an additional floor of a building where you already lease, that would give you an additional right of use asset. If that floor is priced similarly to the price of another floor that you have in the building, then you have yourself a modification that must be accounted for as a separate contract as both criteria have been met. Now, if the two criteria are not met, then the company should reassess the classification of the lease as of the effective date of the modification based on its modified terms and conditions, as in the fair value and remaining economic life of the underlying asset as of that date. I know that sounds like a lot of mumbo jumbo, so we're gonna go over an example of that within the next few slides. Another consideration is noting the commencement date, which is the date on which a lessor makes an underlying asset available for use by a lessee. So for example, the lessee may take possession of or be given control over the use of the asset prior to beginning operations or making lease payments. So because the lessee has a right to use the asset, that is when the official commencement date would be. The timing of when the lease payments begin does not affect the commencement date of the lease. Now, this is a little different under the old standard of ASC 840, where the assumptions related to classification and measurement was determined at lease inception, which was either the date of the lease agreement or the date of commitment by the parties for the principal provisions of the lease. There's no changes to how refundable security deposits are treated. They are not considered a lease payment under ASC 842. Initial direct costs are incremental costs of a lease that would not have been incurred if the lease had not been obtained. So costs to negotiate or arrange a lease that would have been incurred regardless of whether or not the lease was actually executed are not initial direct costs. So think employee salaries, general overhead such as depreciation, occupancy, and equipment costs. But an example of initial direct costs would include like broker commissions and payments made to an existing tenant to incentivize that tenant to terminate its lease. Those would be examples of initial direct costs. With those initial direct costs, lessors can capitalize these costs over the lease term, and lessees can include in the initial measurement of the right to use asset. As Amy had discussed earlier about lease and non-lease components, you would allocate any of those initial direct costs to the separate lease components on the same basis as lease payments, unless you elect a practical expedient of including both the lease and non-lease components as a single component and accounting for it as a lease. Variable payments, variable lease payments are payments made by a lessee to a lessor for the right to use an underlying asset, which because of changes in facts or circumstances occurring after the commencement date other than the passage of time. So there's two different types of variable payments. There's variable lease payments that depend on an index or a rate, and there's variable lease payments that do not. And so for the ones that depend on an index or a rate, they're included in the lease payments for lease classification and measurement based on the index or rate in effect at the measurement date. So the changes to variable payments based on an index or rate after the measurement date will typically be recognized in profit and loss as variable lease expense in the period of the change. For variable lease payments that do not depend on an index or a rate, they're excluded from lease payments for the purposes of classification and measurement. And instead, these payments are expensed as incurred as a variable lease expense and disclosed within the financial statements. So an example of this where it's not a variable lease payment that's dependent on an index or rate would be a retail store that's paying a percentage of sales for a rental space within a mall, or paying an additional amount if for a lease of a vehicle if you exceed a specified mileage. So that's kind of an example of a variable lease payment that's not dependent on an index. Okay, now that we've gone over the basics of topic 842, we're going to go through some examples to help illustrate some of these points. So in this first example, we'll go through a basic operating lease and what happens when there's a modification to the lease. So a lessee enters into a 10-year lease for 10,000 square feet of office space in a building with the remaining economic life for 50 years. The annual payments are $100,000 and they're paid in arrears. There's no stated rate within the lease agreement, and so we're going to use a lessee's incremental borrowing rate at the commencement date, which is 6%. The modification to the lease at the beginning of year 6, it was modified so that the total lease term increases from 10 to 15 years. And the annual lease payments are also increased to $110,000 per year for the remaining 10 years after the modification. So year 1 through 5 would be $100,000. The modification as of year 6 is $110,000. So we'll be looking at $110,000 payments from year 6 through 15. The incremental borrowing rate as of the date of the modification was 7%. So it's different from the original incremental borrowing rate when the lease had originally commenced of 6%. So the modification does not grant an additional right of use to the lessee. Instead, it changes an attribute of the right to use the 10,000 square feet of office space that the lessee already controls. So after the modification, the lessee still controls only a single right of use transferred to the lessee at the original lease commencement date. And because the modification doesn't grant the lessee an additional right of use, the modification cannot be a separate contract. Now that we've determined that we are not going to treat this modification as a separate contract, we now know that we have to reassess the classification of the lease as of the effective date of the modification. So at the date of the modification, we reassessed the classification of the lease and noted that it did not change. It remains an operating lease. We then have to remeasure the lease liability on the basis of the 10-year remaining lease term, the 10 remaining payments of $110,000 and its incremental borrowing rate as of the effective date of the modification. Next slide, please. Okay. So then there's a present value function that you can use within Excel to determine the present value of payments. In this example, I provided the inputs that you would need for this formula to calculate the present value. So on the left side, you'll see that we have to reassess the amounts that we had already paid. So prior to the modification, we had paid $100,000 for the first 5 years. So you'll see the rate is 6% as of the original contract agreement. The NPER is the number of payments that we've made. Payment obviously is the annual payments that we made. FV is future value of a cash balance you want to attain after the last payment is made, which would be 0. And for the type, I put 0. 1 would be the payment at the beginning of the period, and 0 would be payment at the end of the period or in arrears, in which we had stated in an example that they were paying it in arrears. So when you input all of that into Excel using the present value formula, you'll get a present value of $421,236.38. So now that we've assessed the amounts that we've already paid, we want to reassess the new lease terms. So for years 6 through 15, we're going to use an incremental borrowing rate of 7%, which is the rate as of the date of the modification for the lessee. We have the 10 payments left at $110,000. Again, we would put the future value as 0, and they're still paying it in arrears. And so you'll see that the present value of that turns out to be $772,593.97. And so you'll see that the increase was $351,000 and some change. And so you would record this as an adjustment to the right of use asset, and you would increase the corresponding liability. So there's no income or loss effect from the modification itself. Okay, and in this next example, we're going to go through a finance lease. And so for this one, a lessee enters into a 5-year lease of equipment with annual lease payments of $59,000 payable at the end of each year. At the end of year 5, the lessee has an option to purchase the equipment for $5,000. At the end of the lease, the expected residual value is $75,000. Because the exercise price of the purchase option is significantly discounted from the expected fair value of the equipment at the time the purchase option becomes exercisable, the lessee concludes that it is reasonably certain to exercise the purchase option. And so the fair value of the equipment at commencement date is $250,000, and the economic life is 7 years. The discount rate for the lease is not available. So again, we're going to be using the lessee's incremental borrowing rate, which is 6.5% at the time of the lease. So the lessee plans on exercising the option. So because the lease grants the lessee an option to purchase the underlying asset that it's reasonably certain to exercise, the lessee would classify this as a finance lease. So we're going to calculate the present value of the 5 payments of $59,000. So I included all the information that you would need for your formula in Excel, the 6.5% incremental borrowing rate as of the date of the lease agreement, the 5 payments of $59,000 that are paid in arrears. You get the present value of $245,185.09. And then we would also get the present value of the $5,000 purchase option that you would pay at year 5. So here we'll use the net present value formula in Excel. And when you plug this formula in, you'll get a present value of $3,649. So then you'll see that the total liability recorded will be the addition of the 5 payments of the $59,000, the fair value of it, or the present value of it, plus the present value of the $5,000 purchase option. So the $245,000 plus the $3,649, you get your total liability of $248,000. Okay. And so the lessee amortizes the right of use asset over the 7-year expected useful life of the equipment rather than the 5 years, because the lessee is reasonably certain to exercise the option to purchase the equipment, and the equipment has an economic estimated useful life of 7 years. So the lessee depreciates its already owned assets on a straight line basis. Therefore, the right of use asset will also be amortized per the company's policy on a straight line basis. So during the first year of the lease, the lessee would record interest expense on the lease liability of $16,174. And that's calculated by multiplying the 6.5% incremental borrowing rate of the total liability that is recorded. So the present value of the 5 payments of $59,000 plus the present value of the $5,000 purchase option. And the lessee would amortize the right of use asset by $35,548, which is the total lease liability that we calculated 248 divided by the estimated useful life of 7 years. So at the end of year 1, the right of use asset would be $213,286, which is the total lease liability less the $35,548 of the amortization expense that we calculated. And then the lease liability would be $206,008, which is the total lease liability calculated of $248,834 plus the interest expense that we had calculated above, minus a $59,000 payment that you're making at the end of the year. So at the end of year 5, the carrying amount of the right of use asset is $71,094. And that would be the total lease liability we calculated minus the amortization expense over the 5 years. The remaining lease liability is $5,000, which the lessee exercises the purchase option and settles the remaining lease liability. And then you would reclass the remaining right of use asset to property, plant, and equipment by the end of the 5 years. Another consideration that we'll discuss that we frequently see in leases are leasehold improvements. The first thing you have to do when you see that a lease contains a leasehold improvement is to determine if the leasehold improvement is an asset of either the lessee or the lessor. There are some indicators that you can consider that will help you determine whose lease it is. What happens to the improvement when the lease ends? If the landlord gets to keep the gets to keep them or benefits from them, then they likely are not a lessee's assets. Are the improvements specialized to the lessee's needs? For example, if the improvements are specialized laboratory or retail space designed to benefit the lessee, then they likely are lessee assets. Which party supervises and or bears the cost of the build out? Where the lessee is actively involved in supervising the build out or is required to pay for any cost overruns, this may suggest that the lessee is the accounting owner, meaning that the company that accounts for and records the assets of the improvement. And lastly, who legally owns the improvements? The legal owner may indicate who the accounting owner is. So there are quite a few questions that you have to ask yourself to ascertain whether or not these assets are of the lessee or the lessor. So if a lessee has determined that the assets belong to them, then the leasehold improvements with a tenant improvement allowance would be treated as a lease incentive that reduces the right of use asset. So if the allowance is not yet received, then the lease liability is also reduced in future minimum lease payments. So under the old standard, we would have reported it as a separate liability. The liability would have been reduced on a straight line basis and reduced rent expense. Under ASC 842, if it's paid up front, it reduces the tenant's right of use asset, but it adds a leasehold improvement asset in the amount that was paid. So for example, suppose a right of use asset is calculated at $1 million and the landlord offers a lease incentive of $100,000 in the form of a tenant improvement allowance. The result would be $100,000 reduction in the right of use asset and $100,000 in leasehold improvement or property, plant, and equipment assets. So the right of use asset of $1 million minus a tenant improvement allowance of $100,000 equals total assets of $900,000 for the lease plus $100,000 for the property, plant, and equipment. If the improved or constructed asset is a lessor assets, then the improvements are not accounted for by the lessee. We will now go over the required presentation and disclosure of leases under topic 842. So a lessee shall either present in the balance sheet or statement of financial position or disclose in the notes all of the following. The finance lease right of use assets and operating lease right of use assets separately from each other and from other assets. Finance lease liabilities and operating lease liabilities separately from each other from other liabilities. Right of use assets and lease liabilities shall be separated as current and non-current in the classified statements of financial position or balance sheet. And if not presented separately on the statement of financial position or balance sheet, then the lessee shall disclose which line items in the statements of financial position include those right of use assets and lease liabilities. A lessee is prohibited from presenting the finance lease right of use assets in the same line item as operating lease right of use assets and finance lease liabilities in the same line item as operating lease liabilities. So here's an illustrative example of what we just discussed. You'll see the segregation of the finance leases and operating leases under both categories of assets and liabilities. You'll also see that this is a classified balance sheet, and finance and operating leases are also classified as current or long-term. So the main key takeaway is to know that the finance and operating leases should be segregated. Now we'll go over some of the requirements of presentation for the lessee on the income statement and statement of cash flows. For finance leases, the interest expense on the lease liability and amortization of the right of use assets are not required to be presented as separate line items. You would just include them in how you already account for interest expense and depreciation that you already have for the company. For operating leases, lease expenses shall be included in the lessee's income from continuing operations. And in the statement of cash flows, a lessee should classify all of the following: the repayments of the principal portions of the lease liability arising from finance leases within financing activities, payments arising from operating leases within operating activities, variable lease payments and short-term lease payments not included in the lease liability within operating activities. So again, another straightforward example, you'll see interest expense and depreciation expense presented as normal, and a new category of lease expense. And then this will be an example of the statement of cash flow. Well, I have the direct and indirect method here. Again, pretty straightforward. Depreciation expense, the presentation of that doesn't change, including the stuff related to the leases. And then you have the finance lease liability, any reduction of that under financing activities. Okay, and then for disclosures, I have here a list of all the required disclosures for lessee. I won't go through it line by line just for the sake of time right now. I know that we only have 10 minutes, but it is there if you want to reference it. And then on the next slide, you'll see what you have to present in the financial statements for each period presented. Again, I'm not going to go through all of it bullet point by bullet point, but you'll see exactly what it entails. So this is an example of what you would have to disclose, which was in the previous slide, the lease cost, finance lease cost, amortization, the interest on it. This would all be included in your disclosures. This is another more detailed example of the disclosures of all lease related amounts. Again, main takeaway is separating it by operating leases and finance leases. And then here's something new that you'll see is that we need the weighted average of the remaining lease term and discount rate included at the bottom. And then I will go ahead and hand it off to Zena for the next polling question.
Thank you, Sue. So we've come to our third and final polling question. What do you think will be the biggest challenge in implementing the new standard for your organization? A, determining if the lease is an operating or finance lease. B, determining the discount rate. C, determining the journal entries to record the lease transactions. Or D, do not know yet. Please take a moment now to answer. While participants are submitting their answers, I'll provide the third CPE word. The third CPE word is liability. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the third and final CPE word is liability. Okay, it looks like most of you chose C, determining the journal entries to record as your biggest challenge.
Okay, continuing on with the lessee's disclosure, you'll see that a lessee has to disclose a maturity analysis of its finance lease liabilities and its operating lease liabilities separately. So this is actually very similar to what you've probably already seen regarding future minimum lease payments under the old standard. But again, a main difference would be having to separate it between the operating and the finance leases. And you can see an example of that on the next slide. Okay. So again, this probably looks very similar to something that you already have, except that you, again, separate between operating and finance. And then here we have less imputed interest. Okay, next slide, please. Here I have a brief snapshot of the disclosures that are required of lessors. Again, the main objective of these disclosures is to enable users of the financial statements to assess the amount, timing, and uncertainty of cash flows arising from leases, and that applies to lessors as well. So I've listed both the quantitative and qualitative disclosures that you need to make as a lessor. And with that, I will hand it back off to Amy.
Thanks, Sue. I know that was a lot to take in less than an hour, but what we're going to do is try to give you some tips for successful implementation. And really that starts off with including a task force of both internal and external financial professionals who are capable of assessing the impact and being able to help calculate the whole calculation for everything. And obviously that will include your auditors. You're going to need to assess your leases, determine the population of leases you have, determine the type, as we discussed between finance and operating and how they get recorded. You're going to have to determine when your date is that you are using. Is you using the effective date or the beginning of the earliest comparative period presented? And then for each lease here, we have a list of all kinds of things that you need to look at for each lease individually. And that not only considers those extensions and renewals, but if you are definitely going to purchase that asset at the end, and then really calculating that discount rate, which again, obviously is a big piece of coming up with these lease liability calculations. And then basically, Nathan, if you want to go to the next slide, it's basically once you have all this information, you're going to have to evaluate it and record it. You're going to have to document the methodologies you came to, whether it was your risk-free rate or whether it was a finance or an operating lease, and then come to those journal entries, which I know, which was just that was the answer there. And I do think that they are definitely difficult to come about. There's a lot of information that you have to do before you get to there. And then there's an initial journal entry, putting the right of use asset and the lease liability on the books. But then there's those monthly entries of the actual lease expense or the lease cost or the amortization or the interest. So all of this information, I think you need to keep on hand and carefully document, because you're going to need those then at the end of the year when you go to do your presentation and disclosures of your financial statements, and just to support the decisions that were made on how you treated everything. And then don't forget, post-implementation, you need to make sure that you have accounting policies and procedures to support what the decisions were made and that they're documented. In addition, you're going to have some new GL accounts. You may have some new right of use asset accounts. And as Sue mentioned, they're really supposed to be tracked separately between finance and operating, and same with lease liability. So there may be new accounts that need created. And then ultimately as well, if this affects anything of your controls of how you're going through the lease process, you want to make sure you update any necessary internal controls. Finally, once you look at everything, you may determine you need external help, as I mentioned in the number one tip. GRF is here to help. We have a team of lease experts and a software that we use to assist in helping us prepare the calculation and the journal entries that need posted. So there is an additional fee but it may be well worth it for your organization to have an expert take care of this for you. So please contact us if this is something you would like us to assist you with. And then we'll go on to questions. If there's any that haven't, I know we don't have a whole lot of time, so I think a lot of them have been addressed in the chat. If there are any additional ones, we can definitely, please reach out to Sue or myself. We'd be happy to discuss those or to talk through any questions you may have.
With that being said, thank you all for joining today's webinar, and have a great day. Oh, also, please remember to complete the survey that will be at the end via email. And yeah, that's it. Thank you all.